Results for the year to June 14, headline distributions up at 8.3% for the year. Very satisfactory result given, I think, the particularly difficult circumstances in the domestic market. Growthpoint's got three main areas to its business today. The domestic market, which is the retail, office and industrial portfolio in South Africa. The V&A waterfront, which we treat separately and report on separately. And then Australia, the Australian business, which had another very successful year. Highlights for the year has to be the investment activity. It's been probably our busiest year in our history since, let's call it, the rebirth of Growthpoint in 2001, 2002. This financial year, we invested in excess of 15 billion rand into different investments. Now, that is greater than the total gross value of our portfolio that we had in 2007 when we left the Investec group and became independent of Investec. The 15 billion rand is made up of approximately 7 billion rands worth of investments into office properties through the acquisition of the Tiber property portfolio, and the acquisition of ABSEC, which is also predominantly an office portfolio here in the northern suburbs. Added to that is about 1.9 billion rand of additional investment into our Australian subsidiary. The Australian business was also had a very busy year with over $350 million of new investment, and Growthpoint partly funded that through sending another 1.9 billion rand worth of to Australia to follow our rights and maintain our position as a 64% shareholder in Australia. In April this year, we also bought strategic stakes in AccuCap and SciComm. Bought 34.9% of AccuCap and about 23% of SciComm, and that was a 4.5 billion rand transaction where we bought the shares from institutional investors and swapped them, essentially gave them additional Growthpoint shares. In addition, we had over 1 billion rand worth of acquisitions and developments on our local balance sheet, and all thing, if you add all of that up, we had over 15 billion rand. So a very, very busy year from an investment perspective. Fortunate enough to have been able to fund that through the issue of over 9 billion rand worth of new equity. So we didn't have to leverage up on the borrowing side and take our gearing levels and our debt levels to unacceptable levels. It's moved up from 24.7% to 27% in South Africa. So very conservatively geared and very well within the norms that we set for ourselves, where we try and keep our gearing to below 40%. If I move to the waterfront for a second, waterfront had a phenomenal year. The growth in distributable income out of the waterfront grew at 6.4%, but it is similarly a very active investment year at the waterfront. Our share of capital spend was about 279 million. The PIC, our partners there on behalf of the Government Employees Pension Fund, matching that. So just short of 600 odd million rands worth of additional investment into the V&A waterfront, which is it really seems like a microcosm cosm on its own, where we saw turnover rentals in the waterfront, or turnover in the waterfront, growing at over 20%, which is more than 3 times the level we're seeing in the rest of our portfolio shopping centres across South Africa. So the Western Cape, I think, with tourism, with a weak rand, tourism being the beneficiary of that, a lot of that filtering through into the trading at the V&A waterfront. We also have got tremendous demand now in the waterfront for additional developments in the form of hotels, in the form of new office buildings. We'll be building a new 4,000 square metre gym for Virgin Active, additional residential. Our first residential stock, which is residential to let, has also now hit the market in the waterfront, creating a new income stream for us at the V&A. We've got over 3 billion rand worth of new development expenditure over the next 3 years in the waterfront, and very, very exciting opportunities down in Cape Town. Australia, the Australian subsidiary, our like-for-like distributable income out of the Australian subsidiary grew at over 13%. So a major contributor. I think Australia now makes up just on about 15% of our total net income and distributable income. And as I mentioned, a successful year, 350 million rands worth of new developments. And we continue to look at further opportunities for growth in the Australian market. We currently only have office and industrial properties in our portfolio there. We are slowly but surely starting to explore investment into the retail sector as well. So in all, a very successful, a very busy year, and at 8.3% up on distributions, ahead of what we guided the market when we put the guidance out at the beginning of the financial year, which in the order of about 7.2%. Looking forward at the next 12 months, we are perhaps a little bit cautious given the domestic economic situation with very low economic growth, with higher interest rates and labour unrest, and also recently the turmoil in the financial or in the consumer end of the market with Elleren's going into business rescue. So we're guiding for distribution growth of between 7 and 7.5% for next year, which is very much in line with the average that we have achieved over the last 5 years.